Hello, and welcome back to Financial Triage, where we talk about financial planning and how it impacts your finances. If we look a little different tonight, it's because tonight's episode is completely remote. Please bear with us with the technology. We are going to cover a lot of information in each episode, as everyone is in a different place financially and has different values and goals. Not all of this information will apply to you. You can download the slides by using your camera app on the QR code, which we will show periodically during this broadcast. If you have questions, please note them in the chat at any time. We will answer all questions at the end. As we are going through these topics, if there is a particular segment, topic, or situation you would like to see a future seminar about, please leave it in the chat or message the organizers at academy@bedfordpresbyterian.org. My name is Jennifer Climo, and I have been providing income tax advice to individuals and small businesses for over 30 years and financial planning advice to individuals and couples for over 18 years. I am both a certified public accountant, CPA, and a certified financial planner, CFP. The views expressed today are mine alone and are not the views of either Milestone Financial Planning or Bedford Presbyterian Church. Nothing you hear today should be considered investment advice. Do not make financial decisions based on this or any other seminar, but instead meet with a qualified financial advisor regarding your specific goals and financial circumstances. Note that almost all financial decisions will affect you now or in the future. Well, they'll impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future returns. TRIAGE is the acronym we came up for this series of classes, and today's topic is the G in TRIAGE, generosity. This is my absolutely favorite topic. At the end of today's class, I hope you will understand what makes people happy, the many ways you can give in the most tax-efficient manner, and the tax consequences of giving to individuals. Do not store up for yourselves treasures on earth where moths and vermin destroy, and where thieves break in and steal. But store up for yourselves treasures in heaven where moths and vermin do not destroy, and where thieves do not break in and steal. Matthew 6:19-20. Why give? What makes people happy, content, and fulfilled? Many of us are waiting for that next job, to meet someone special, accomplish some goal, before we think we will be happy. I'll just be happy when. The truth that we don't like to admit is that happiness comes from inside ourselves. Other people, more money, and more stuff can give a temporary boost to our mood, but it can't make us truly happy if we aren't able to find happiness within ourselves. Financial contentment is understanding that money and things are not what provide fulfillment. Contentment comes from having a purpose, a sense of gratitude for what we have, time spent with family and friends, or making a difference in this world. The happiest people are often the most generous. I have met with many people with plenty of money who are not happy. Happy people tend to be grateful for what they have, and they're doing what they love. And it doesn't have to involve a lot of spending, and there really isn't often a correlation with a lot of money. One couple I've worked with over the years travels the U.S. very frugally, working for months in communities damaged by natural disasters. They have logistical support skills and are able to help the communities rebuild. They meet lots of new people, the work is fulfilling, and they're making a difference in people's lives. In Mark 10, Jesus tells us a parable about a rich man. A man came up to Jesus and asked him what he must do to inherit eternal life. After confirming he had obeyed the commandments, Jesus told him the thing he hadn't done. Go and sell all your possessions and give the money to the poor, and then you will have treasure in heaven. The man went away sad, and Jesus' disciples were confused. Who in the world can be saved? It's easier for a camel to go through the eye of a needle than for a rich person to enter the kingdom of God, is what Jesus said. This is a really tricky passage to understand. I personally didn't understand it for a very long time. When you have the opportunity to make a difference in people's lives, I suggest you reflect back about this passage. I think the following story might be able to help us shed some light. It's about a person named John. John always wanted to tithe to his church, but he thought he just couldn't afford it. Not only that, but when his income dropped substantially during the pandemic, he stopped giving altogether. He was super stressed and most definitely not happy during this period. John's cousin Vinny had been struggling financially for a long time. John found out that Vinny couldn't get to work because his car was broken and he couldn't afford to fix it. If he couldn't fix it, he couldn't work. He often had to rent a car to get to his low-paying job, further reducing his income. If he can't work, he can't pay rent. Stepping in and helping that situation was not as easy as paying to fix the car. There's also car insurance, registering the car, fueling the car, and making sure Vinny didn't sell the car to pay for his living expenses. Then come to find out, Vinny can't afford health insurance. It was entire education for John and what it is like to be poor. In order to get a credit card with a $1,000 limit, Vinny had to give the credit card company $1,000 as a deposit. Vinny had experience with overdrawing his checking account, so he used a check cashing service up the street to cash his paycheck instead. It cost him 2% of his check every week, but that was a lot less than paying for bounced check fees. Vinny wasn't a drug addict or a drunk. He didn't have a gambling addiction or mental health problems. He was just poor. Grew up without any support or positive role models, just trying to survive one week to the next. John decided to take a huge leap of faith. He took the contents of his savings account and helped Vinny fix his car, buy health insurance, gave him the time and support to find a better job. At the same time, John decided to tithe to his church. The combination of these expenses were substantial, and it dented John's net worth. However, John states he feels a peace in his heart, is more accepting of others, and yes, is happy with his life. Also, from a financial planning perspective, John still has enough to meet his goals. He won't go hungry. He still has a roof over his head. He still has savings for his college and his own retirement. John was grateful for all he had. You don't have to give just out of your income. You can also give from your assets. You can give to people or charities. Charitable giving strategies can be relatively simple, with minimal cost. Complicated, expensive strategies are generally not needed, although we'll briefly mention a few tonight. If you are charitably inclined, there are several ways you can take advantage of the tax code and meet your charitable giving goals. If you remember the discussion from our last episodes, we discussed what a required minimum distribution, or RMD, was. This is the amount of money you are required to remove from your IRA or 401k each year and be taxed on. The RMD for your IRA is due by April 1st of the year following the year you turn age 72. After that, you must take the distribution by December 31st each year. IRAs inherited from a non-spouse prior to 2020 also have RMDs. Qualified charitable distributions, donor-advised funds, and gifts of appreciated stock are all relatively easy ways to meet your charitable goals and get a tax deduction. My favorite one of these strategies is known as the QCD, Qualified Charitable Distribution. You must be age 70 and a half at the time of the donation to take advantage of this strategy. You can transfer up to $100,000 per year from your IRA or inherited IRA to the charity and never be taxed on it. Even better, it reduces your income because it counts as your RMD, and you won't be taxed in that year on your RMD, so you can employ other tax strategies in that year to minimize your lifetime income taxes. Another charitable giving strategy that is relatively simple is the donor-advised fund. This way, you can bunch your charitable contributions into one year and maybe get a tax deduction for it. The DAF, Donor-Advised Fund, is a separate account with separate fees. It is legally separate from you, which is why you get a tax deduction in the year you transfer assets to the fund. you can transfer appreciated stock and avoid paying the capital gains tax. Once the assets are in the DAF, they can be sold tax-free. Then, whenever you want, the same tax year or a different tax year, you can direct the DAF to make gifts to the charities of your choice in the amounts you choose. Another version of gifting appreciated stock is to just transfer the stock directly to the charity. Whether you contribute appreciated stock to a DAF or directly to the charity, no one will pay taxes on those gains, as charities and donor-advised funds are tax-exempt. Just make sure the organization you choose is a 501c3 charity, religious organization, or government. If it doesn't qualify, you don't get the deduction. Donations to political organizations, GoFundMe, family and friends, or other individuals do not qualify as charitable deductions. If you donate by check or credit card, you can deduct up to 60% of your adjusted gross income per year. If you give appreciated assets such as stocks, exchange-traded funds, ETFs, or mutual funds, you are limited to a deduction of 30% of your adjusted gross income per year. In both cases, donations greater than that are carried forward to future years. The nice thing about using appreciated stock, checks, credit cards, QCDs, or DAFs is that you can do this while you are alive and see the influence your giving has made on the world. If you would rather, wait until after your death. Naming a charity or your church as a partial beneficiary on your IRAs, 401k, 403b, TSP, or taxable brokerage account can be a very easy way to include the charity in your estate plan. A beneficiary designation supersedes your will or trust and can be changed at any time with your financial institution without legal fees. Do you have an annuity that you have not yet annuitized? Consider making your church or another charity the beneficiary on the annuity. You will have diffused an income tax bomb. You can still eventually annuitize the annuity. The beneficiary only comes into play when you pass away. Do you have an unneeded life insurance policy? You can make the beneficiary your church or another charity. Starting with deaths in 2020, whoever inherits your IRA is subject to taxes on the balance by the end of the 10th year. If a percentage of the IRA passes to charity, then no one pays taxes on that amount, and the entire amount that passed to the charity can be used for the mission of that charity. Why not to use a bequest? The most efficient way to pass your assets to your heirs is through a combination of beneficiary designations and a revocable trust. By structuring your estate this way, you will avoid probate, an expensive, time-consuming, and public process, and ensure your wishes are carried out shortly after your death. We will discuss probate in more detail next class on estate planning. By naming beneficiaries on all accounts, nothing will pass through your will, and you may avoid probate. Your will is there to catch anything you forgot to assign a beneficiary to. A will is subject to probate. If nothing passes through a will, probate time and expense is avoided. If you leave a bequest in the will, the charity has to wait for probate and the estate has to pay for probate. Also, if all your assets have named beneficiaries or are owned by a revocable trust, nothing will pass through your will and the charity may get nothing. A common estate planning error is to not be aware of the interaction between your revocable trust, beneficiary designations, and your will. Naming a charity as an IRA beneficiary is an efficient way to leave assets to charity. The charity can receive the funds within days of your death, your privacy is protected, and no one pays taxes on the money. Sophisticated giving strategies. We will briefly describe some more complicated giving strategies that are more appropriate if you have large sums of money that you don't need during your lifetime. CRATs and CRUTs, Charitable Remainder Annuity Trust and Charitable Remainder Unitrust, are a combination of an annuity and a charitable donation. You give a sum of money to buy a stream of income, either a fixed percent, which is a CRAT, or based on a percentage of the value of the assets, which is a CRUT. At your death, the remainder goes to charity. You get a tax deduction at the time you set up the CRAT or the CRUT. or a charitable lead trust, CLT, where the stream of income goes to charity and then the balance goes to your heirs. I imagine we will hear more about CRATs, CRUTs, and CLTs when and if the estate tax limit is reduced, as these are popular estate planning techniques. How do you find a charity you want to donate to? You may not want to donate to a charity which already has a huge endowment fund, or many millions of dollars on hand, or one which pays its executives millions of dollars. There are websites that can help you compare charities based on their public filings. Charity Navigator and GuideStar.org are two examples. How to evaluate a charity's finances. On either of these websites, you may be able to download the latest tax return from the charity. This is an example of Families in Transition, a charity in Manchester, a local nonprofit that operates a food bank and a used clothing store, among other things. Also one of my favorite charities. I love their thrift store. Page 1 of their tax return, called a 990, shows me they have about $10 million in annual revenue and net assets of about $12 million. You've circled them on this slide, but it might be too small for you to see. But if you were looking at the page 1 of their tax return, it clearly calls out total revenue and total assets. Net assets is equivalent to net worth or retained earnings, so I know this is a relatively strong charity. Now you need to decide if the company is well managed enough for your contributions. I would say yes. If you flip through the rest of the return, you can see things like how much its executives are paid. Does a lot of money go out to the board of directors? How much goes directly to programs versus administration? There's a lot of information on this tax return. That's why they call these informational tax returns. There's no tax calculation. Nonprofits don't pay any tax, but they still have to file this form with the IRS every year. And it is a matter of public record, which is why these websites are able to publish the information. Giving to individuals. You can also give to individuals, but this kind of giving may or may not result in a gift tax, or at least a gift tax return. Anyone can give $15,000 per year, up to, per person, without gift tax consequences. In addition, you can pay an unlimited amount for a person's medical care or education if you pay the facility directly with no gift tax consequences and no gift tax return consequences. For example, you can pay college bills directly for your grandkids, and there is no gift tax ramification or gift tax return. Ditto for paying your parents' medical bills directly or health insurance. The gift tax applies to the donor, that's the person giving, the person making the gift. A married couple can give $30,000 per year per person. If a couple decides to give up to $30,000 to one individual, they should each file a gift tax return to elect gift splitting and start the statute of limitations. Gift tax is only payable if an individual dies with an estate greater than your lifetime tax exemption, now currently $11.7 million. However, if that limit is reduced in the future, this may be an area to watch. Note that gifts include monetary gifts as well as funding of expenses. For example, if you pay for someone's rent or the cell phone bill of an adult, if you have made a gift and it has to be aggregated with all the other gifts you have made, including the bills you have paid on their behalf. There are also exceptions to the gift tax for dependent situations. That is, paying the expenses for a dependent is not considered a gift. However, once your kids turn age 24, or if they're over 19 and no longer a full-time student, and they earn more than $4,300 for the year, they are no longer considered a dependent, and your paying their bills may be considered a gift. Another example of a gift is if you contribute more than $15,000 per year to your child's 529 account. You are able to front-load your contributions to a maximum of 5 times the annual gift limit, but that uses up your annual exclusion for those 5 years for that person, and any other gifts made in that period would be subject to reporting on a gift tax return. In addition, you need to file a gift tax return to report the front-loaded contribution to your child's 529. If you do make any gifts greater than $15,000 per person per year, you need to file a gift tax return by April 15th the following year. You may not owe any gift tax, as you can offset the gift against your lifetime exclusion. If you are required to file a gift tax return, you must also lift any charitable gifts on the return, although they are not taxable. You can transfer appreciated stocks or mutual funds to people in low tax brackets. In addition to the gift tax, there are several things you need to be concerned about if you give assets to other people. Number one is if the individual's income is less than $40,400 in 2021, $80,800 if they're married filing joint, they pay nothing on their capital gains, 0% tax rate. This can be a very tax-efficient way to give to others. Your cost basis carries over to the new owner, so if you have a large built-in capital gain, they'll be liable for those taxes, if any, if they sold it all in that year. If their income tax limits are less than the above, they won't pay any income taxes. There's some really good tax planning opportunities here. Beware of the impact of this additional income, however, not from the gift, because gifts do not result in income, but if you give an asset and the asset produces income, that income earned from the gift can add to their other income and affect any benefits they were receiving. By giving a person assets or additional income, you could be disqualifying them from public assistance. Note, they might still qualify for Medicaid health insurance, as Medicaid no longer has an asset level for health insurance purposes for people under age 65, although it does have an income limit. Summary. Most cost-efficient and tax-efficient ways to give to charity include from your IRA or inherited IRA after age 70 and a half, that's the QCD, which also counts as your RMD if you're over age 72, up to $100,000 per year per person. Gifts of appreciated assets such as stocks or mutual funds or ETFs or real estate, either direct or to a donor-advised fund, via beneficiary designations at your death, and you can split these. You can set a beneficiary designation, so say 10% goes to your church and 90% to your kids, or 50-50 or 100-0, however you want it. Any other percentages you want, and you can change your mind as many times as you want before you die, and it doesn't cost anything to change your beneficiaries. It's just a piece of paperwork with your financial institution. To individuals, you can give up to $15,000 per year per person. And when giving to individuals, make sure you consider the impact of the income and or the assets on their specific financial situation. Because as we talk about, not only do financial decisions have tax consequences, they can also have financial consequences if there are any subsidized benefits that people are receiving. How you give logistically isn't as important as that you give. I challenge you to be extravagantly generous. Once you start giving generously to the people and the causes that matter to you, you may find that the benefits are greater than you expected. You can choose to be grateful for the blessings in your life and share them with others. Your gifts can change lives. Generosity may change you. Every time I make a sizable donation to my church or to a charity, I may be monetarily poorer, but I am infinitely richer. My day-to-day life is not impacted by the financial gift. I still have a roof over my head and food to eat. Creating these triage classes has been a goal of mine for several years. When I was approached by my church with the opportunity to teach classes on financial planning through their academy program, I was both excited and terrified. I tend to avoid public speaking, so this was way outside my comfort zone. Also, I suddenly had to write 7 hours worth of material in a few weeks. However, every time someone thanks me for teaching, I get an endorphin high. There's nothing greater. I want to spread the word so more people can experience the joy of giving. I'm very grateful to Bedford Presbyterian Church for giving me this opportunity to share, and to all of you for watching. We only have one more triage class left, estate planning. Thank you for sticking with us through all the material. I hope you have found some of it helpful. I want to thank the people that made triage possible, as this was a massive team effort. Thank you specifically to Mark Marai and Abby Dopfer for filming, Derek Climo and Kyle LaBelle for setup, Erin Metazinski for help with my slides, Beth Everett for promotion, Marcia Morgan for technical assistance, Brianna Bergeron, Aaron, and Jenna Rose Finney for giving me feedback during practice, and my wife and kids for being patient with me as I spent every weekend writing and practicing the material. Special thank you to Bethany Avery, Academy Elder at Bedford Presbyterian Church, for giving me this opportunity, and to all of you for watching and asking questions. Please join us next week for the final installment, Estate Planning. Are there any questions on giving? Thank you for the kind comment, kind words. I don't see any questions. We have no live questions today because we are 100% remote. Thank you for bearing with us for the technology. Okay, well, thank you very much, everyone. We'll see you next week.